Hi, Nikita Burdick here. And yes, I'm in workout gear, but that's because I am lounging at home. But I wanted to jump on really quick to talk about the past few days. I have a full market update video being recorded tomorrow that'll release within the week. However, I wanted to give you some information in the meantime. So I want to start. I know the Federal Reserve has announced their hike today, and we're going to get into that. But I first want to talk about what's been happening the past few days, okay? So what we've had is the UMBS was down by more than 60 basis points, and what we saw is that rates were getting a lot worse. I had one client that went into contract that as of yesterday, if I had locked him at a 5.875%, he would have had 3 discount points. Now, if you don't understand what discount points are, they're points associated with the rate that a client has to pay in order to get that rate, or if there's a lender credit, it can buy it down to a certain point. Okay. And this client really wanted that 5.875 or the 5.75% interest rate. I decided to float the client based on the indicators in the market. And when I say indicators in the market, I'm looking at the charts and I'm determining what is happening. What can I see as far as trends that would help me to be able to determine whether to lock or whether to float. I decided to float into after the Federal Reserve meeting, and we're going to get into the reasons why, because I'm going to turn my screen to the chart that we're going to look at together. But in short, what I was able to do was I was able to save this client. Now the 5.875, instead of being 3 discount points, was only 2 discount points today. The client will not be paying the full 2 discount points because in this particular file, we will be giving a credit. But there is that, if you can see, a whole discount point is 1%. On a $300,000 loan, that's $3,000. On a $500,000 loan, that's $5,000. That is just by waiting one day and understanding the markets. You want to make sure you work with a lender that understands the market so that way you can take advantage of the different market swings. So anyways, what I want to do is I want to turn my camera, position it where you can see my screen. So on my screen, what you'll see here in this general spot, you'll see what these are called are candlesticks. And these candlesticks are on this UMBS, the UMBS, the mortgage-backed securities chart. And the candlestick kind of tells us what's happening. So in this particular candlestick, you see a long wick at the bottom after there's already been a downtrend. That's called a hammer, and that's why there's an H there on that flag, right? So when we see a hammer after a downtrend, what that's telling us is there's likely going to be an uptrend or maybe a better in pricing. So what I did with this particular client is I said, okay, let's not lock today because the market is telling us that there might be some kind of an uptrend. And also the market itself was reacting to what it potentially thought that the Fed might do. And so the UMBS was way down. There's other factors that go into why the UMBS was down. But in light of the Federal Reserve meeting coming up and the fact that last time we had a basis hike, the interest rates actually got better, I decided for this particular client that it was better to not lock and to wait. So I did, and that's what I look at when I determine whether I'm going to lock or whether I'm going to wait. I did, and it saved my client a whole percentage point. So I turn the camera back to myself and I want to talk about the Federal Reserve meeting. This is not my full market update, and I will have a video going over the charts and what we look for and what candlesticks are and all of those different things. But in this video, I just wanted to give a snippet of what's been happening. So today, the Federal Reserve raised their federal funds rate by another 75 basis points or 0.75%. This is bringing the target range to 3 3/4%. Okay, this does not mean that your interest rate just rose 75 basis points or 75.75%. As you saw, it actually saved the client money by waiting for the waiting not just for the Federal Reserve hike, but also because the market signaled that there's going to be some type of increase. Okay, Now, I want to talk about particularities that I found with Powell's speech that's worth noting. First, he said that they are going to continue their goal of price stability and that they're going to get inflation to return to its 2% target. Okay. Ongoing increases are going to be necessary and appropriate. However, and I'm going to look at my screen because I want to give you exactly what he had said. And what he had said is that at some point it will become appropriate to slow the pace of increases. However, that decision will be made meeting by meeting. He also stated that restoring price stability will require maintaining a restrictive policy. And he also cautioned that historical data strongly advises against prematurely loosening any policies. So what this is telling me is that Powell believes that we need to keep going strong with the federal hikes, and that he does not see in the near future, even with good market data, the reason to slow down the hikes, because that would be premature. This is just my reading into what he had said in his speech. It is by no ways indicating what I believe the hike to be or what the next federal hike will be, but we are likely going to see more federal hikes to the federal funds rate. In any event, my full market update is being videoed tomorrow, and it will be released within a week. Here's just a snippet for you for now. Thank you.